Hello and welcome. Thank you for joining us to our very first webinar 1.0. How does MarketsFlow manage investment portfolios using our award-winning platform? How are we different than others? We've got a lot to cover, so let's get into it. I'm Tom Nash. I'm the founder and CEO of MarketsFlow. I'm also joined by Adam Tyrrell, who is the portfolio manager. Right. So, as you are well aware, we specialize in scientific investing. So, why is that important? Let's dive straight into it. When you look at the markets, there's one thing which stands out, and those are numerical representation of buys and sells, bid prices, ask prices. So whether you look at the indices, or you look at a sector or an industry, or the group of securities within a security, they always end up with a particular price at the end of the day. So whether a stock is going up or a stock is going down, they are represented by numbers. These are the facts on the ground. What does that mean? That means the markets are quantitative in nature. Now, this is very important because from a human perspective, we're generally conditioned to understand things in a qualitative way, and we rationalize our feelings with some sort of substance. So, for example, when the markets are grinding up, we like to think that the markets are in a momentum behavior, or we're in a healthy economy. At the same time, if we're in a bearish state, we like to think that something is wrong with the economy. So we like to always rationalize our feelings with some sort of news items. However, the facts on the ground are that markets behave in numerical ways, and that is all what matters at the end of the day.
So here on this slide, we can see the occurrence of MarketsFlow signals over time and how these map into different market circumstances. And this is very, very important in the sense that a large part of how MarketsFlow's performance is generated is by having the portfolio orientate itself far more bullishly when markets are rising, and to almost completely eliminate market exposure when markets are falling, and then at various different flavors of market in between. We may have intermediate exposure. And actually our analysis shows up that, looking at this over periods of months, quarters and years, that timing effect is really a very significant part of how the performance is generated. But it all comes from fundamentally these bottom-up signals that are delivered at a stock level, which they're not just buys and sells, they're different strengths of buy signals. And so this is really the fundamental building block of everything that MarketsFlow then does. This then maps through a process into portfolio management process, and then that determines the exposures held from one day to the next and through time. This is really where it begins.
Thank you, Adam. Yes, so we are certainly shaping the future of investment management. We believe in order to understand data and apply science, we need a sophisticated system, and we've got one at MarketsFlow. It all starts with the client financial goals, where the clients input details around their circumstances, risk profile, and their objectives around returns and performance. Once we've got that data, our platform then constructs a portfolio which includes a universe of stocks. The portfolio construction mechanism is dynamic in nature because the markets are dynamic. It then produces optimal beta based on the client profile, and that particular beta of the universe of stocks helps to make decisions around allocation. So as Adam alluded to, on a daily basis, we get to see buys and sell signals. I'm going to be showing you the platform bit later on in this webinar, and you'll be able to see how we look at that on a daily basis to make our allocation decisions. At allocation level, we are actively making decisions on a daily basis what to buy or to invest in stocks, or to sell puts to sell puts or sell a covered call, which is another way for us to allocate decisions. We also rebalance on a daily basis when there are sell signals. That helps us be acute in the understanding of where the markets are, and be agile to the market performance. And then finally, the portfolio metrics help us create ratios to help the portfolio remain in terms of its capital invested ratios, its allocation decisions, its risk management, and you'll get to see that later on. I would be showing you the portfolio. Right, okay.
What this slide is showing us is a much longer term perspective than the day-to-day nature of things that I was speaking about a minute ago. And really, this is what it's all about. We wouldn't expect to say with great confidence that over a period as short as a week or a day, we would be highly confident at outperforming other investment managers or market indices. But really, where the value accumulates and where you can really see the difference start to build is over the medium term. So the multiple quarters, the multiple years. And here is really where you can see a profile of returns in the case of MarketsFlow, which is not only more strongly upward and more consistently upward than what we're comparing it with, which is the S&P index and also a peer group of 50 hedge funds, but also the volatility of those returns on MarketsFlow is less than with the S&P 500. So if you take that combination of both stronger performance and lower volatility, then all of the risk return based measures where you tend to risk adjust and compare performance across sectors, performance across different investment managers, really MarketsFlow is winning on both on the returns and on the risk.
Great. Okay, now it's time to dive straight into the platform. So here we have the dashboard, and you can see we've got the main window where we can see the performance of the portfolio over the last 2 years or so. And we have the pane where we've got different open positions. We can see most of these positions are options, so short dated options where we were able to extract around sort of 0.5% within 2 days of expiry. Right, how do we get to that? So on any given day, we look at the portfolio management side of things, which is here. So we're looking at the December 12th. We have no buy signals, so let's look at sell signals, and we see we've got majority of sell signals. What does that tell us? That tells us that there is compression in the market. The markets are volatile, and certainly we need to cut our exposure. So fairly simple. That helps us be active in terms of how we deploy our portfolio capital. And if we are to move to another date around 24th, we see that there is more volatility in the market, and we would make decisions. Yes, here we go. So clearly we've got just 2 non-sell signals and no buy signals. Now, if we are to move on to a different period, so let's look at Jan 16th for that matter, we end up with, just takes a little while, right, we have more of a concentrated signal. So we've got buy M2, M3 and M4. Now you might be wondering what M1 to M4 stands for. So M1 is the strongest signal, M2 is second level strength wise, and M3 is the third level, and M4 is the weakest signal. Now, why is that important? That is important because that helps us define the position size. And why is position size important? Because that helps us plan the portfolio allocation such that it's well risk managed, and that is all scientifically driven, as you can tell. let's look for the same day. So on the 16th of Jan, we've got just one sell, but we do have a majority of buy signals. Now that is very different than what we saw in December. So this is really the sort of agility, the sort of sophisticated advancement in our platform that helps us navigate the markets on a daily basis. So for the period of December, you saw that slide which Adam talked about, where we were less exposed, and hence we did not see the performance depreciation which you saw with majority of other portfolio managers. So now again here, once we have the buy signals, we're able to either make the decision around buying a stock or selling a put options, which is another way for us to achieve extra yield without much exposure. Another aspect of what we do, which is very scientific in nature and helps us achieve optimized performance, is by looking at our capital invested. So if you see, we're very agile. So our invested ratios here are 9.79, and then you can see that they went up to, they were 70% a few days back. On the allocation side, on the right, you've got 9 positions, and then they drop down to 3, 1, and 4. This is very important because the markets are dynamic, and as a result, your portfolio should be dynamic. With that said, let me also show you some transactions. Or right, so here's another sort of screen where we look at on any given basis whether we should be invested into options or stocks, so that this gives us an overall indication of where we are from an allocation perspective on a daily basis. Right. So I'll move on to now, how are we different than the others in the industry? So right. Okay, great. So how are we different than other investment managers? Well, firstly, as you can tell, that sophisticated platform of ours, which as you know, has won 3 awards in a row for the last 3 years, that underpins our investment management philosophy and technology. All our investment decisions are driven out of the platform, and that is how we're able to achieve improved performance and minimize our volatility and drawdown periods. Now, we know from experience that whether a small investor or a large investor, what they like is performance, certainly, but they do not wish to take the downside, and they do not like periods of sustained volatility. And therein, that this platform helps us achieve the management of volatility. Now, how does that differ from other investment managers? Other investment managers make processes which are make decisions around processes. Now, a process may include a screening team which analyzes stocks which may go into a portfolio universe, and they may be decided over a period of time. By then, the markets may have changed. However, their process is still stagnant. And then a portfolio manager or a fund manager may allocate decisions based on those screening of stocks which may have undertaken in a period where the markets were different. And the portfolio manager generally would then be making allocation decisions, which are usually buy and hold, and then you may end up in a case where the market may be non-related or non-correlated to where the allocations is.
So I suppose, Tava, are you saying that it's that lack of ability for traditional investment management decision processes to respond to day-to-day changes in market conditions? That's really a key drawback that they're up against.
Absolutely, Adam. Great point there. Yes, true. I mean, the markets are dynamic in nature, and hence the management of your portfolios should really reflect that. And this understanding of using the and harnessing the power of technology helps us to optimize our positions and our allocations, rebalancing, which then translates into this optimized performance, whether we're going through different periods, whether it's a bullish or bearish period. That is the key. Right. With into the other aspects of what makes us unique is our ability to control the portfolio. Now, the fact that we all expect control in our lives, and having a portfolio with the ability to be able to execute on a certain performance, whether those are meeting your risk profile objectives or your return objectives, is key. So therefore, we apply that control using these specific signals, both on the buy side as well as the sell side. The other investment managers, firstly, the smaller ones, lack control because usually the investment processes are farmed out to third parties. And where managed in-house, there is usually a lack of definitive process of managing allocations and rebalancing on a daily basis. So that's really the key differentiator between us and traditional investment managers. Right. So with that said, this is our first webinar, and here are our details. Thank you for joining us, and we hope that you'll be able to join us in our next webinar. Thank you very much. Take care.